You know, when you hear the name MicroStrategy in the crypto world, you think of one thing, right? Bitcoin. They are, without a doubt, the largest corporate holder of BTC on the entire planet. Every move they make sends ripples through the market. But what if I told you that hidden deep within their public filings is a story of incredible leverage and, honestly, massive risk? It's a story that suggests the biggest bull in the market might just be setting the stage for the next major crypto crisis. Let's dig in. So that brings us to the central question for today. What if Bitcoin's biggest corporate champion is also its single greatest point of failure? We're about to peel back the layers of corporate finance to uncover a potential black swan event that, frankly, every single crypto investor needs to understand.
All right, first things first, who exactly is MicroStrategy? Yeah, they've been an enterprise software company for decades, but if you look at their own filings now, they call themselves the world's first Bitcoin development company. It's wild. And trust me, they have absolutely put their money where their mouth is.
This is the reason we're all here today. 226,331 Bitcoin. As of their latest update, that's what MicroStrategy is holding. To put that in perspective, that's over 1% of the total supply that will ever exist. This isn't just a small part of their corporate treasury. This is a complete reinvention of a company into a leveraged bet on Bitcoin. And how they got here is the real key to this story. Their game plan, which they lay out pretty clearly in their financial reports, is both simple and incredibly aggressive. Use capital from issuing new company stock and taking on debt to just continuously buy more Bitcoin. This is so much more than buying the dip. It's a highly leveraged, debt-fueled buying spree that has made them the absolute whale of all whales. But as we're about to see, that kind of leverage has a very, very sharp edge. So, our deep dive started with a clue, one we found buried deep in a recent SEC proxy statement. Now, at first glance, it looks like just boring, standard corporate procedure. But when you actually look at the numbers, well, it's nothing short of staggering. And this slide right here just lays it all out. On the left, you've got their current authorized shares. On the right, what they're proposing. MicroStrategy's board is asking its shareholders to approve an increase from 330 million shares to over 10 billion. No, that is not a typo. It's a 30 times increase in the company's ability to just create new stock out of thin air. And the big question is, why on earth would they need that much firepower? Now, of course, the company gives a list of standard justifications in their filing. They say they need the shares for things like ongoing equity offerings, employee pay, and, crucially, to have enough shares on hand to settle their convertible notes. These all sound like pretty normal business reasons, but let's zoom in on that convertible notes part for a second. And this brings up the real question, right? Are these just routine corporate housekeeping justifications, or do they mask a much more urgent, more structural need for a massive safety net of potential cash? To answer that, we have to flip the book over and look at the other side of their balance sheet. And that leads us directly to the other side of the ledger, the absolute mountain of debt that MicroStrategy has taken on to fund this Bitcoin buying spree. And it's a very specific kind of debt, the kind that ties the company's fate directly to its stock price. They've mostly used a financial tool called convertible notes. Let me break down how they work real quick. The company borrows money, right? But instead of just paying it back with interest, the lender gets the option to convert that debt into company stock at a preset price. It's a brilliant tool when your stock is soaring, but it also creates a huge obligation of future shares you have to pay out. And just look at the scale of this. Seriously, this is straight from their filings. The company has a whole series of these notes coming due between 2027 and 2032. If you add it all up, they represent a potential issuance of over 42 million shares. This is the bill coming due. They're going to need either the cold, hard cash to pay back, or they're going to need the shares to settle the debt. And this is probably why they need to authorize billions of new shares to handle this massive wall of debt conversions looming on the horizon. You see how this creates this really dangerous feedback loop, right? By using debt to buy Bitcoin, a high Bitcoin price boosts their stock, which makes it easier to manage their debt. Everyone's happy. But if Bitcoin's price were to fall off a cliff, the value of their main asset would crater. Their stock price would follow, and the pressure from this mountain of debt would become absolutely immense. Okay, so let's connect the dots. Let's put all the pieces of the puzzle together. We've got the largest corporate holder of Bitcoin, a massive debt load used to buy it all, and a request to authorize billions upon billions of new shares. You mix all that together, and you have the perfect recipe for a crypto black swan event.
So here's how the dominoes could fall. First, you get a severe, prolonged drop in the price of Bitcoin. This immediately puts huge pressure on MicroStrategy's balance sheet. Second, that financial pressure could trigger certain rules or covenants on their debt, forcing them to come up with cash or collateral that they just don't have. And that leads to the critical third step, of forced liquidation. They'd have to start selling their Bitcoin, not because they want to, but because they have to pay their creditors. And that's when the real market cascade would begin. A forced sale of this size would be nothing short of catastrophic for the market. I mean, think about it. Dumping over 200,000 Bitcoin would flood the exchanges with supply, absolutely cratering the price and triggering liquidations across the entire ecosystem. It would create a vicious downward spiral. Their selling pushes the price down, which makes their financial position even worse, which forces them to sell even more. This is the textbook definition of systemic risk.
Okay, deep breaths. That's the doomsday scenario. So, what does all of this actually mean for your portfolio, for you as an investor? There are 4 really crucial takeaways here. First, understand systemic risk. The crypto market is way more interconnected than we like to think. Second, always be wary of leverage. It is rocket fuel on the way up, but it is a lead anchor on the way down. Third, you have to look beyond the headlines and the hype. The real story is often buried in the fine print of documents just like these SEC filings. And finally, diversification matters. The risk that MicroStrategy poses is a powerful reminder of why having so much of the market supply in one place creates vulnerability for absolutely everyone.
Now, let me be super clear about this. This analysis is not a prediction that MicroStrategy will collapse. It's a cautionary tale about what could happen. It's a risk scenario that's built entirely from the company's own public statements and financial data. And it really just highlights why you have to do your own research and always look for the risks that are hidden in plain sight. The crypto space moves at lightning speed, and understanding these hidden financial structures is absolutely crucial. If you found this breakdown valuable, help other people see the bigger picture by hitting that like button and sharing it around. And of course, for more deep dive analyses just like this one, make sure you subscribe to Crypto Explorer 24/7. Thanks for joining us.